We're basically doing the same mistake we did in 2008, which was trying to solve a debt problem with more debt.
So welcome back, Dr. Frank. So in December, we saw the US Federal Reserve raise their target range for the federal funds rate. So several leading economists have said, we've seen this before, this is a mistake. This happened in 1936, and following that was the Great Depression of 1937. Do you agree with this, Dr. Frank?
Well, I actually wrote an article on this, okay? And the mistake we're making is assuming that what happened in 1937 was due to monetary policy that was followed in 1937. In reality, the Depression of 1937 was actually due to monetary policy that was followed in 1934, 1935, and 1936. We have to remember that the US government raised gold prices to $35 an ounce, which caused a capital inflow and which caused the money supply to surge over 12% in those 3 years. And at the end of 1936, Mariner Eccles, who was then the chairman of the central bank, had this to say. He said that recovery is now underway, but if it was permitted to become a runaway boom, it would be followed by another disastrous crash. And he was absolutely right. And the 1937 recession or depression would have been a lot worse had monetary policy not been tightened in 1936. And I'm afraid that we've done the same mistake today in that we didn't tighten monetary policy back in 2012, and we will have to pay the consequences, which is another disastrous crash.
So the Bank of Japan has recently started selling negative interest rates on excess reserves. And this has also been seen by central banks in the EU, Switzerland, Sweden and Norway. So in your opinion, Dr. Frank, will this be effective?
Well, the purpose of setting negative interest rates on excess reserves is basically to force banks to make more loans so that this will spur economic activity. We're basically doing the same mistake we did in 2008, which was trying to solve a debt problem with more debt. And it's this view that the economy is a car and that interest rates are the gas pedal. And this is a totally distorted view of the true role of interest rates in a capitalist economy. And you can bring a horse to water, but you can't make him drink. With the global economy heading into a recession and with very few credit-worthy customers, banks having very few credit-worthy customers, it's unlikely that by setting negative interest rates, you're going to see a significant increase in loans being made in the economy.
And we also have some government bonds that are selling at negative interest rates. In your opinion, Dr. Frank, is this a mistake?
Well, as we can see from this graph, we currently have almost $7 trillion that are trading below zero. Now, economists will tell you that this should be an impossibility. In other words, why would you pay $1,002 for a one-year government bond that will only get you $1,000 in a year from now? Okay, you could just as easily take $1,002, stuff it in your mattress, and in a year from now you'd have $1,002. Okay, which is more than 1,000. And very few people understand that the only reason interest rates are at negative rates for government bonds is that people who are buying it at $1,002 expect to sell it to the central bank for more than $1,002. Okay, and in the end, the central bank will have purchased an asset that will be worth less. Okay, now how is that not monetizing the debt? Something that Germany was adamantly opposed when we created the ECB in the first place.
Well, Dr. Frank, thank you so much for coming in today and sharing your insights with us. As always, it was a pleasure.
Thank you.
Well, that's all from myself and Dr. Frank, but for all the latest Dukascopy updates and exclusive interviews, do keep clicking back. Goodbye for now.